Debt versus equity financing for a small business. As your company expands and the need for fresh cash becomes pressing, which funding route do you take? Getting investors or getting a loan? Check out this program to understand the intricacies of equity financing, that is, investors, versus debt financing, that is, loans, especially when it comes to the paperwork, the cost, the risk to the financier in your business, and the legal aspects. Welcome back, folks, to another edition of Sweetie Kiwi. How you doing today? I hope you are doing fantastic. If you are doing as great as I am, go grab a cup of coffee or tea or vodka. Let's roll. Today I want to talk to you about debts. I want to talk to you about equity. I want to talk to you about debt versus equity financing for your small business. Now, how do you get debt financing? Debt financing, getting a loan for your business, is the most common type of financing for businesses, especially those who are just starting out. If you're a startup or you have been in the business for a few months, you will get debt financing, or you might need debt financing. Now, what is the ease of getting a business loan? Now, it's never easy to get money for a business startup, but debt financing in the form of a business loan is usually straightforward and quick. So the process generally will begin with you preparing financial statements and a business plan to take to lenders, right? Financial statements here, I'm talking about a balance sheet, a statement of cash flows, an income statement, and an shareholders equity statement. And you also need a business plan. Now, you can prepare this document yourself, but it's always a good idea to have a financial advisor take a look at the financial statements. That advisor can be a CPA, a certified public accountant. It could be an EA, an enrolled agent. It could be a regular accountant, but someone who has experience with your industry and also with the kind of startup you are actually initiating. It can take months to get a business loan. Remember, especially if you just starting out and your credit score and everything else is still in the initial stages, you may have to put up some of your own money, collateral, in the process also, and you may also need to give a personal guarantee or get a co-signer. So compared to finding investors, it's still easier to get a loan. Another thing is control of the business. When you have a loan, the lender has almost no amount of control over your business, which is different from equity financing route. They may ask for periodic statements to make sure your business looks financially sound, but you and other co-owners keep the control. You have full control of the business and also control of business decisions. Now, what is the cost of business loans? Now, debt financing comes in the form of the cost of debt financing comes in the form of interest payments, right? Of course, you still have to pay the principal amount, but the cost here is the interest that you pay on the loan. So every quarter or every month, your payments will comprise a portion of the principal and the interest. Now, because business loans are risky, the interest rate may be high. Now, the rate ultimately depends on several factors, including the age of the business, the credit rating of the business or the owners, if it's a new business, and the type of lender. Now, one thing I haven't said also is that another factor that is very critical here is the industry in which the startup is operating. If the lender believes that the risk is high based on past experience or based on current trends, they might increase the interest rate. Now, let's talk a little bit now about the risk of business loans. Now, if your company cannot pay its bills, the lender can call in the loan and you may be required to pay it back. Now, the risk to your business is the possibility that you wouldn't be able to pay back the loan. And in this case, the adverse effect will be that your business credit rating will go down and possibly cause you to go into bankruptcy. That's one. The next thing is that if you have given a personal guarantee or you have provided collateral while signing the loan documents, the business might go after you or after your assets. Depending upon the legal structure that you have in your business, whether it is an S corporation or a C corporation or an LLC, a limited liability company, or a sole proprietorship, the amount of exposure, the amount of liability exposure you have will differ. All right, we have dedicated an entire show. We have an entire show on the business legal structure and the impact of business loans and the impact of personal liability versus business liability in that show. So you might want to double check that. I'll be right back right after this, and I'll speak to you about how to get equity funding. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. We are still continuing our conversation. We're having a comparative analysis of debt versus equity financing for a small business. If you love the content clarity and quality so far, please consider subscribing to our channel and turn on the notification bell so you know when we drop a new show in real time. And we do this every single day, rain or shine. Please comment below, share this content, and like it. How do you get equity funding? Now, the way you get equity funding depends on the type of funding. Again, when we're talking about equity funding, we're talking about seeking investors. Now, the types of equity funding, you have private investors. So your company can decide to get individual shareholders and consequently keep the company private, right? This is the simplest type of small business investment, because you're reaching out to individuals as opposed to institutions. When you hear the terms institutional investors versus retail investors, it's just that institutional investors are companies. There are organizations, of course. They are deep pocketed. They have more money than retail investors, but things could get very complicated too when it comes to due diligence, all the requirements, blah blah blah. So the simplest type of small business investment, I was saying before, is from private individuals as friends and family, right? So businesses in technology or biotech, for example, they may be able to get venture capital or angel investors because those fields are seen as promising. They're seen as high potential fields. So you can incorporate your business and offer shares in stock to a select group of people without offering shares to the public, in which case you're not a public company. So if you can persuade these people to invest in your business, you'll need to put together an agreement. And of course, I always say reach out to an attorney for this to make sure everyone knows what to expect. That's for private investors. Now you have another route, which is seeking public investors. So when a company gets larger and wants to grow more, the typical route is to get people to buy shares of stock in the business. So if the organization wants to go public, it can arrange to have an IPO of stock. IPO stands for initial public offering. So this process takes much time and money because you'll have to hire lots of people, from investment bankers to Wall Street attorneys to regulatory attorneys. So most small businesses don't go public until they are very large. Let's talk about control of the business. So equity funding, whether it is private or public, involves giving up control of the operations because the investors want to be sure the company succeeds. Right? So you'll have to put shareholders on your corporate board of directors, and they will be looking over your shoulder to make sure their investments are doing fantastically. Now, ease of getting equity funding. It's relatively easier to get private investors, especially if they're friends and family, than it is to get public investors. It is much more difficult to get venture capitalists or other investors, for that matter, to pay attention and put together a deal. So a private stock offering requires financial and tax professionals and probably years to put in practice. Now, if you have the money, if you have the right financial backing, that 5 years or 3 years can be cut down to 3 months or 6 months. What is the risk of equity funding? Investing in business, as we all know, is risky. It's a risky proposal, right? The investors must understand that if the company closes or goes bankrupt, they will probably not get their investment back, which is not the case with lenders, because lenders have possible recourses afforded by the courts. So even family members may become disenchanted if they don't see a return within a few years. So the idea here is, as a small business owner, you need to balance your personal goals with the goals of the company and also the goals of investors or lenders for that matter. And you have to strike the right balance here. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We are still talking about debt versus equity financing for a small business, and I've given you, we've done the pros and cons of debt versus equity financing. Now, before closing up today's show, I want to talk to you about two important sets of documents for a funding round. If you are a small business and you want to get out there and get external funding because you don't have the cash internally, you need to prepare, whether it is for a loan or an equity round of an equity offering, a private stock offering. You need to get two important sets of documents, and this will be very helpful because whether the lender or investor wants to initiate a due diligence process, they'll need to get a look at your preliminary documents. Number one, the first category of document is financial statements. Now, as I said earlier, there are four main financial statements. You have the balance sheets, the income statements, the cash flow statements, and the owner's equity. Now, the balance sheet is sometimes called a statement of financial position or statement of financial condition. In that document, you show the assets, what the company, what your startup owns, and you show the liabilities, what the startup owes, the debts. And the difference between the asset and the liabilities is the net worth. In other words, the equity of the company. And then you have the income statement. That statement is sometimes called a P&L, the profit and loss statement, or statement of income. Those names are interchangeable. Then you have the cash flow statements, also called the statement of cash flows. Now, cash flow statements has three categories of information. So you have the cash flows from operations, cash flows from financing activities, and cash flows from investing activities. And then you have the owner's equity. Owner's equity, you have the retained earnings, you have all the cash, the paid-in capital, and the common stock into the company. Now, besides the financial statements, you have the business plan. A business plan, there are so many templates on the internet. At a minimum, you want to have in a business plan the executive summary, the strategic plan, the SWOT analysis, and the uses of funds. Of course, the financial statements are an integral part of the business plan. So when you have to explain the uses of funds, you need to tell investors first, you need to show investors a complete set of financial statements and tell them how you're going to use the funds. One thing I forgot to mention is that when it comes to financial statements, you also have the accompanying something called the supplemental information, the disclosures, because financial statements are prepared in accordance with standards. In the United States, those are called GAAP. So United States generally accepted accounting principles. So that's US GAAP. And you have to say, and if you are targeting an international investor base, you have to prepare your financial statements in accordance with something called IFRS, International Financial Standards, Financial Reporting Standards, IFRS, International Financial Reporting Standards. So whichever the case, you need to put the accompanying disclosures that tell investors and lenders how you came to prepare the data in the financial statements. Now, I was talking about the business plan, and I mentioned something called SWOT analysis. SWOT stands for strengths, weaknesses, opportunities, and threats. This is some kind of matrix that you use to identify what's really happening in the industry and how likely your company is to survive and thrive. Remember, though, when it comes to those two important sets of documents, financial statements, and business plan that even though there are gazillions of templates on the internet, if you are looking for some serious money, you need to get serious. So unless you have acumen in business or accounting or have someone on the team with that expertise, it's better to get experts help. Hire a CPA, hire a financial consultant, a financial advisor. Anybody who has expertise when it comes to business planning and financial accounting can help you. Now, there are some lenders and investors out there, again, especially when the amount solicited, the amount sought, the funding sought is high, they would require something called audited financial statements. In other words, they're not just relying on you or your team preparing the financial documents. They want an external accounting firm or audit firm to confirm that the information that you are showing them makes sense, and that the information is adequate and accurate to the best of their knowledge, right? So those are things you need to know about when it comes to financial documents and financial reports. So this is it, folks. So just kind of wrap up here. You have to understand that if you need money to finance your startup or expansion, you got to figure out what kind of options works for you. It's easier to get a loan and you keep control of the business, but the cost can be high interest rates and the change to the lender will foreclose if you don't pay. It is more difficult to get investors and they will demand control of the business. So investors take a large risk because they could lose all their money. For that risk, they demand high returns. So if you're just starting the business, a business loan might be your best bet for raising money. All right. Let me quickly recap today's conversation. So I was talking to you about debt versus equity financing for a small business. I spoke about how to get debt financing. So the ease of getting a business loan, you retain the control of the business. The cost of the business loan is high. The risk of business loans, you can be foreclosed upon. And then I spoke about how to get equity funding. So the types of equity funding available out there, you might lose a portion of the control of the business. It is relatively easy to get equity funding, and there is a risk of equity funding. And finally, I spoke to you about two important sets of documents for a funding run, and that's financial statements, so the balance sheet, the income statement, the cash flow statements, and the owner's equity. And the second category of the second documents that you need is the business plan. And business plan at a minimum will have an executive summary, a strategic plan, a SWOT analysis, and a financial section that talks about the uses of funds and a full set of financial statements with the required disclosures. Now, I always say get expert help if needed. And some lenders might require you to have audited financial statements. I will see you another time. But until then, remember, stay marvelous.